Good morning and welcome to this Wednesday, March 15th, 2023 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, yesterday felt good, and yesterday was yesterday. Now we've got futures down today. Currently, we've got Dow futures down about 600 points. S&P 500 futures down about 75, NASDAQ futures down about 190. This is coming on the heels of more turmoil in the financial area. At least at this point, Credit Suisse looks like the latest bank crisis to hit that group. The stock is down considerably today. Actually, I can probably give that to you. Let me see where they're currently trading. Credit Suisse is down. There we go, down 27%. So we closed yesterday at $2.51. Today it's trading at $1.84 in pre-market. So this financial crisis, obviously one of the biggest risks is contagion. It's hard to really rifle through all the news and try and figure out exactly, what's factual and what's not. I mean, obviously, we've got a crisis. I'm not trying to say that there's not an issue there, but how deep it is and how widely affecting the banking system it is, I'm not quite so sure. We'll probably hear about that quite a bit next week when the Fed meets and we get the policy decision next Wednesday. What I can say, though, is that I am firmly on the side of Goldman Sachs. And I don't say that too often, but Goldman Sachs is one of the few that have come out here in the last couple of days and said the Fed should not raise rates on Wednesday as a result of this. They got more evidence this morning, by the way, that they probably shouldn't be raising rates when the PPI came out. The PPI showed, well, first, the expectations on the PPI was that it was going to rise 0.3% for the month of February. Instead, it dropped 0.1%. That's the headline number. If we strip out food and energy, core PPI was flat, and the market was expecting a rise of 0.4%. So yesterday's CPI came in just about as expected. PPI this morning out below expectations. I mean, I'm not sure why the Fed would want to raise. I mean, they've been raising since May of last year or even before that, but I know the Fed funds rate in May of last year was at 1%. And we have had multiple 50 basis point hikes, a 25 basis point hike. This is, rates obviously are moving up. And I think the Fed needs to be really careful here because obviously the banks are already under some stress. How much stress, we don't know, but we know that the stocks are getting hit pretty hard. And another rate hike and raising that the short-term treasuries, I mean, that's what a rate hike is going to do. While you've got the long-term, the long end of the bond yield is continuing to drop this morning. Let's see where we are latest. Right now, we've got bond yields at 3.46%, down 18 basis points this morning. So when you've got yields on the long end of the curve falling, and you've got the Fed continuing to hike, sending the short end higher, you're getting a massive spread between short-term treasury yields and long-term treasury yields. And that can be a big problem for banks in any given market, but especially now with the stress that they're already feeling. So my guess is that the Fed needs to back off on these hikes and concentrate a little bit more on what's going on in the banking world and less about what's going on in inflation. Because, like I said, the inflation report out this morning was very tame, came in much lower than expected. But we'll see how the Fed processes all this. Personally, I think the Fed's been making a mistake by raising as much as they have anyway. But anyway, we'll see what the Fed comes up with next week. Let me share my screen with everyone. And we will start off this morning taking a look over at our website. This is for those of you that are new. I want to welcome everyone to the show, especially those who are finding us for the first time or have only been with us for a couple of shows as a result of our YouTube live streaming. We certainly appreciate you coming in. I can tell you that our approach is probably a little bit different than most approaches to the stock market, and that is we do a ton of research and we do the best we can in passing along a lot of education to those who are listening in our audience, hopefully helping you manage your finances over the long term. That's really the goal. It's all about education. We provide guidance, we provide research. So hopefully as you listen in, you'll start to learn a little bit more about us. If you want to take the next step, find out a little bit more about how we approach the market, I would strongly suggest you go over to earningsbeats.com, scroll down and sign up for our free Earnings Beats Digest newsletter. I write this newsletter. It's a very brief, 2 paragraphs, 1 chart kind of a newsletter. So you're not going to be spending your entire day checking out this newsletter. Hold on 1 second. Okay, thanks. The newsletter focuses on things that are important to us. So we look at things like earnings. Obviously, with our name, Earnings Beats, we study earnings pretty closely. My background was in public accounting for 20 years. I'm also a technician. I've been, looking at the market technically for probably 30 or 40 years. It's been a huge passion of mine. And when I got out of public accounting, we started up Earnings Beats and haven't looked back. And again, the goal is really to help educate the public. And we try to do so through our Earnings Beats Digest community. That's kind of how you can get a good start listening to the shows and then also signing up for our newsletter. Name and email address is all it takes. Hit that subscribe button. No credit card required. You can unsubscribe at any time. No questions asked. If this is something that adds to your investment knowledge, maybe improves your trading success, great. If we don't set up for you style-wise and you don't think this is helping you, that's fine too. We're not for everyone. I get that. Some think we trade too short term. Some think we trade too long term. Quite honestly, I am personally a swing trader. I'm looking in a solid market. Now, I would not call right now a solid market. We've been struggling. I think we're putting in a bottom. I think the bottom is in, but we're not exactly rolling to the upside at this point either. So in this kind of a market, I tend to stick mostly with ETFs, the QQQ, the Spider, that sort of thing. If I'm going to get aggressive, I tend to look at leveraged ETFs. So instead of the QQQ, I might look at the QLD, which is 2 times the QQQ, or the TQQQ, which is 3 times. I think those can be used effectively in certain situations. I would not hold them long term. The volatility, you tend to see a lot of erosion in those juiced ETFs or leveraged ETFs if you're holding them while they go up and down, because they're designed to track the underlying index at a 2 times or 3 times clip for 1 day. They're not designed to track 2 times or 3 times for 6 months. It may turn out that way, but with a lot of volatility, you also see a lot of erosion. Anyway, check out the Earnings Beats Digest if you're not already a subscriber. If we do any free events, this is where we go to. In addition to our paid members, we reach out to our Earnings Beats Digest community. All right, moving on. So what happened yesterday? Well, yesterday was a good day. We haven't had many good days, especially in March. Been seeing the market come down. Yesterday, big move back to the upside. And this came on the heels of a big gap down from a couple of days ago. So, we've rebounded pretty nicely off those lows. Now it looks like maybe we're going to push back to the downside again. But the Dow Jones yesterday did finish up 336 points, or a little over 1%. S&P up 65 points, which was 1.7%. The NASDAQ 239 points, which was 2.14%. So you can see the more risk in the index, the better it performed yesterday. And so risk on is, from a bullish perspective, that's what we want to see. The problem is we're not seeing it often enough. We saw it back in January, But since the beginning of February, and especially since the middle of February, the market has been struggling, and we've seen most of our major indices moving lower. Mid caps yesterday up 1.9%, small caps up almost 2%. Remember, they had horrible days, and they've had a horrible week leading up to yesterday. So getting a little bit of a bounce, but we got a lot of work to do technically on those two indices. Looking at the sectors, money was rotating in positive fashion yesterday. And that's been the theme really throughout 2023. Communication services, technology, financials, and discretionary leading on an up day, which is great, because the day before when we had a down day, most of these groups, other than financials, were nowhere to be seen. Most of the aggressive groups have been holding up fairly well. Utilities also did well yesterday, and utilities have done well throughout the month of March. I think month to date, this is your top performing sector. And again, when I sent out our March seasonality report to our members back at the beginning of the month, this is the group we focused on. We said March is for utilities. This is the month that utilities have their best relative performance going back the last couple of decades. So utilities like the month of March on a relative basis, and you can see it's happening again. We're now back up above the 20-day moving average. I think we got a shot to run for the 50-day, which will be up closer to $68. It's not, utilities aren't shiny. They're not all pretty. They don't move fast. But in a month where we tend to see a little bit of more safety, folks historically looking for a little bit more safety in March, I think utilities can be a good hedge. All right, 10-year Treasury yield. So let's talk a little bit about the economic reports this morning. We had the February PPI, as I mentioned at the top of the show, that came out at minus 0.1%. Market was expecting a rise of 0.3. We strip out food and energy. The core PPI was flat for February, and the expectation was for a rise of 0.4%. So that's partly responsible, in my opinion, for the 10-year Treasury yield moving down. It's now down 18 basis points to 3.455%. So I think the lower PPO, lower than expected, I think certainly is adding to folks moving into bonds. When you start losing out, when, inflation is less and less of an issue, then you're more likely to want to be in long-term bonds. So that's why I think we're seeing some money rotate in there. Also, retail sales. Retail sales were down 0.4%. Market was expecting 0.3% drop. So retail sales, the headline number came in a little bit weaker than expected. I think that also is playing into some of that weakness in the 10-year Treasury yield. And then also the banks, just the fact that the banks are struggling. We're seeing that, the yields come down the long end, which is why, in my opinion, it makes sense for the Fed to be thinking about lowering rates, not raising them. But again, we'll see what happens next week. I think if the Fed sticks with their plan of raising rates, I'm not sure the market's going to like it next week. Not with what's going on. If the banking issues continue to escalate, even if there's the perception that they're escalating, even if they're not escalating, but the public perceives it and starts with, taking out deposits and so forth, that any kind of a run on deposits on banks would not be good. Banks start losing their depositors, they have to start taking on less risk. And if they take on less risk, it means fewer loans. Fewer loans means, our debt-ridden society, we all like to borrow to try and grow. That's the way it works in the US. That isn't quite so easy when banks are unwilling to lend. So if credit availability begins to drop, then you start to see some real issues. And that's why I think the Fed needs to be lowering rates and providing financials with a more cost-effective way of, attracting funds. But we'll see how the Fed handles this. I'm not a big fan of Chief Powell, as many of you probably know. I think the market doesn't really trust him and this particular Fed. For a long time, they didn't want to raise rates. And hey, I'll admit it, I was wrong too. I didn't think they should raise rates from the very beginning. And inflation became a much bigger issue than I thought it was going to be. I'll readily admit that. But I don't think it's a long-term issue. And I think, there's no pandemic playbook. We've gone through a pandemic and it's still having ripple effects everywhere. And, last time we had anything similar to this from a healthcare perspective was 100 years ago. Markets were completely different back then. So it's really hard to pinpoint exactly what should be happening and what the Fed should be doing. Trust me, I wouldn't want their job. Even though I don't really think that Powell's done a great job, I wouldn't want it because I do think it's a difficult job. He's got a lot of things to try to juggle, and I'm sure he's doing the best he can. I can promise you he's a very smart man. The whole Federal Reserve is filled with men and women that are very sharp. They're extremely bright, but it doesn't mean that they don't make mistakes from time to time. I think if they raise next week, it's going to be a mistake, but we'll see. What else we got today? Let's move on to the S&P 500 first. So here was your bounce yesterday. We had a nice hollow candle from back on Monday. So we gapped down. Remember to open the week. We gapped down, and then we had some recovery, but then we kind of sold off again late in the day. Well, yesterday we gapped up, had a period of selling, but then rallied and finished near the close. If we look at an intraday 10-minute chart, and you can see this is where Stock Charts was having issues with their data vendor. And so a lot of intraday charts, a lot of intraday feeds were not working. So don't have the benefit of exactly where we went. What I can tell you is that we started on Monday down, and then we rallied, and then we finished back down at the end of the day. And then back to the upside yesterday. Then we sold off until about 3 o'clock, and then another big rally in the final, 40, 50 minutes. Now, what we can look at is the QQQ, because that does give us the intraday data. And one of the things I was looking at was this channel. Hold on one second. Let me show you. So we had the highs in place. So sometimes what I like to do is just kind of draw a line connecting the highs, which is somewhere around there. And then what we can do is drag that line down here to the bottom. Now, we can put it on the candle high or candle body, because that's kind of what I was using here, was the candle body. And if I use the candle body here, look at where we came down to on an intraday basis yesterday, exactly to that level. The other thing is we had this bottoming head and shoulder pattern. So left shoulder, neckline, head, neckline, right shoulder, and then breakout. So we also had this pattern here, right around 294, maybe just below 294. Let's call it 293.80, something like that, that we broke out above. We came back down, we tested the neckline, and then took back off again. Now, looking at this yesterday, I would have thought we were going to go higher at the open. I mean, we have room down here at about 294. And let me go ahead and save this. So we have room back here down to about 294. Well, let's take a look and see where the Qs are intraday, because we are below that, I believe. Yeah, 293.40. So 293.40 would be right in about here. So unless we improve here in the next 10 minutes, it looks like at the open, we're going to move below this trend line. And trend lines can be very subjective. I mean, we could do this. Let me annotate here. I could say, okay, let's go from the intraday highs, that intraday high over here to this high, and then let's get rid of this, and then let's drag this from the intraday low. And now we've got this low at 293 right now. So if we open at 293.40, we're okay. Do you see how channel lines and trend lines can be very subjective? I can kind of make them do whatever I want them to do. A trend is only as good as the number of points that it connects. So here I'm connecting 2 points. Here I'm just connecting it from 1 point. I liked it better when I was up here because I'm at least, essentially connecting 2 points. But just remember, trend lines, channel lines, you can make them look like whatever you want, which makes them a little bit less reliable than an actual price support. Because if I'm looking at this neckline coming across here, I know pretty much that it's right around 293.80. And even taking the most, not really conservative, maybe aggressive is the right word, I don't know. But taking a more aggressive approach to this channel line, going all the way to this bottom, you can see we could come into 293 and be okay. So based on this, if we gap down today, we get down closer to 293 and then we bounce off of it, then this is going to be a channel that I would continue to watch. If it breaks down below 293 significantly, I mean, if we start talking 292, 291, as far as I'm concerned, this channel, this trend line, whatever you want to call it, is gone. There's no more use for it at that point. We'd have to wait for another one to develop. All right. NASDAQ 100, big move here. We were yesterday getting close to a trend line. So if you look at the daily chart, there's a couple of different ways to connect. Again, we could connect candle bodies, which would be closer to that, or we could connect from intraday highs, which would be that. And here you can see we actually connected 3 points. We never got back through that. So we still have what appears to be a short-term downtrend in play. And if we drag this down here, you can kind of see that the lows connect as well. So this is maybe a down channel in the short term to consider. Now, there are a lot of other things to consider. And so let's take a look at some of those actually, let me go ahead and take a look at those now. So the first thing that I would suggest that we do is, where was that? Oh, here it is. So here, as we're going down on the S&P, there's no doubt that we're in a downtrend since the beginning of February. I'm bullish. I can't paint a picture that doesn't exist. We're downtrending, right? I mean, we're still up off of the lows here. We put in a higher high and a higher low and a higher high. So far, we're still holding this low. So I'd say the intermediate term right now is more uptrend. Long term is downtrend, and short term is downtrend. But what I want you to look at here on this chart down below is growth versus value ratios. When you talk about possible recession and you talk about a banking crisis that could lead to a deeper recession, you talk about higher inflation, if you want to go that route. You talk about all these things. I would not want to own growth stocks if I was worried about any of those things. I mean, up until last week, there was a lot of concern about the 10-year Treasury yield continuing up, moving higher. We had seen the yield move back up above 4%. Wasn't too far from the high. I think down here, So down here, we actually intraday got to about 430, maybe on an open. And then intraday right around 430, maybe as high as 433 back in October. And we were heading back that way again. And notice that as the rates were going up last time, look at these ratios. This is growth to value. This is large cap growth to large cap value, IWF to IWD. When rates were going up last time, these growth stocks were getting hit across large cap, mid cap, small cap, which makes sense. They should get hit when rates are going down, or excuse me, when rates are going up. But look at the rates since mid-January going up through February and into early March. 10-year Treasury yield was going up. And look at growth stocks during the same period. There's small caps, mid caps, large caps. What's going on? Look at the IWF, IWD, and the growth, large cap growth versus large cap value. They are at roughly 5-month highs. Does that make sense to anyone? I mean, yeah, recently we saw the rates just come down, which sent these growth stocks up even more, but they were going up when the 10-year Treasury yield here was going up. So here we saw the yields coming down. And of course, that certainly led to more strength, but this started even when yields were going up. So the story that we're hearing in the media, I just have a lot of problem following the news, because to me, it's not news. It's just opinions and it's clickbait. I say this all the time. I write over at Stock Charts. And if I write something with a bearish headline, I'll get 3 to 5 times as many views as if I write something bullish. People are drawn to bad news. They're drawn to the train wreck. And do you think all these media outlets don't know that? They want viewership so that they can get more ad money from their sponsors, their advertisers. They want you to click on their articles. How do they do that? They do that by giving you the worst news possible. And that's what we've been seeing again. Now it's just the next story. We've gone from story to story to story. It was the pandemic, then it was inflation, then it was higher rates, then it was the recession, now it's the bank collapse. And here we are, the S&P 500 is higher than it was in June of last year, but even May. To me, that's when all the manipulation started, right from this May low. Money began rotating and has continued rotating in bullish fashion since May of last year. It takes a while for Wall Street to accumulate all the shares they want before the next move to the upside. And I think they're taking advantage of all these different news stories. And I'm not saying that some of the news isn't true. Banks are absolutely having some problems right now. Interest rates absolutely went higher. Inflation absolutely was a problem and still continues to be to some degree. The pandemic, clearly that was a problem. Much more health related than financial related, but it was still a problem. I'm not saying these problems don't exist. What I'm saying is that the media is using it as a way to attract more and more viewers. They're blowing it up, blowing it out of proportion. And our minds get trained by that. And we don't look at the stock market the same. We don't have the ability to see what's taking place under the surface. And what I can tell you is taking place under the surface, without a doubt, is money is rotating into more aggressive areas. And you got to ask yourself why. This was just a chart on the XLP consumer staples relative to the S&P 500. Usually when the market goes up, this ratio goes down. When the market goes down, this ratio goes up. So it's usually an inverse correlation. And if you need proof, here's your correlation, showing you the correlation between the relative performance of consumer staples versus the S&P versus the S&P itself. So there's an inverse correlation, meaning that when the stock market goes up, consumer staples tends to underperform. When the stock market goes down, consumer staples tends to outperform. It tends to be opposite. All these readings below zero are telling you that's true. That's a true statement. This is going back 5 years during bull periods and bear periods. Now, when they go in the same direction, you have to at least be asking yourself why. Here, at the end of 2021, staples were leading the S&P 500 to their final high. That's unusual. That was a warning sign. Now, it doesn't mean that every time we go above zero, it's a warning sign, but this is a chart worth watching, because what I would expect is that we would stay down here relatively close to minus 0.75, minus 1. That's where we are right now. So nothing bad going on at this point, or nothing strange with staples. I just wanted to point it out, though, because it's another way to perhaps look at something that's going on under the surface of the market that we need to be aware of. All right, last thing I'm going to do, the market just opened. I want to do one thing, and that is the banks have been weak. How do you find strong banks? How do you know which ones are the strong ones? Which ones are the weak ones? Well, if I was going to do this, what I would do is this. I'd go in and I'd run a scan. And so I'd go to the dashboard, go down to your scans. If you don't see your scans, then it's because over here on the gear shift, if you click on that, you don't have scans and alerts checked. So click on that, make sure that's checked, save your preferences, and then come down here and you should see your scans. Now, new scan. So what I'm going to do here is, well, actually, I do want to make sure I have stocks that are liquid. So let's do a 20-day, no, let's do a 90-day, which would be about 4 months worth of activity. And let's just say we want to make sure that we have at least 300,000 shares trading on average over the last 90 days. Next thing we want to do is go down here under industries and go down under the financials and look for banks. Put that in there. Now, if you want to know which ones are performing well on a relative basis, one way to do it is to go in and then put in Scooter score. Add Scooter. It comes up as a default greater than 90, but banks have been very, very weak lately. Most of the Scooter score is going to be well below. I'm going to just put 70. If you've got a Scooter score of 70 in the banking group right now, you probably have a pretty good. Let's just see how many stocks come up under the scan. I have not run this, so I have no idea, but here we go. Right now we have nine stocks. One of those is JP Morgan, which is in one of our portfolios. If we do it in Scooter order, you will see that the top one right now is Banco Santander, Bancorp Bank, TBBK. But you can see that one doesn't trade much in volume. I would not trade. I'd want to see a lot of shares being traded. I know the market just opened, but I don't. Well, let's just see what Bancorp Bank looks like. Actually, volume's not too bad. So this one, if we pull up on a relative basis, relative chart, down here, you can see TBBK relative to the banks has been trending higher for months, and it continues to trend higher on a relative basis. That doesn't mean it's not going down. The whole banking group is taking it down, but it's been one of the better performers in the banking space. So I would say its exposure, and I'm just making a, maybe a little bit of a correlation here between what's going on in the chart and what is happening maybe fundamentally. But I'm going to say that this stock probably has little exposure to crypto or to other banks that have exposure to crypto, because it's not really getting hit hard. It's still near a 52-week relative high. So that's a bank that looks pretty interesting. How about the one that was top on the list? Let's go back and look at this Banco. No, that's not the right one. Here we go. Banco Santander. Let's look at that one. Getting hit. Today it's down 9%. But again, if we pull up that relative chart, it has been an unbelievable relative strength leader. So, I mean, it's only a $3 stock, so that might turn a lot of folks off. I don't usually look at stocks that are priced that low. But on a relative basis, it's been a great performer. Now, today it's breaking down below the 50 days, so you're getting a technical breakdown, even though relative strength still looks pretty good. I don't know if this would be a chart that you'd be interested in or not. Right now, I mean, the banking group is so volatile, I'm not really interested. But if I was in the banks, I would want to be in a leader. That's my point. If you wanted to be diversified, just make sure that you got to have a leading stock in the banking area, which is why, by the way, we would never have been an owner of SI even before all of this happened. Why? Because look at the relative strength. It was at a 52-week low before any of this happened this year. Wall Street was avoiding Silvergate Capital. That's what you can tell by relative strength. So I've had a lot of folks that have written in and said, how do you avoid stocks like this? Relative strength, I'm not going to say it's going to guarantee you that nothing can go wrong, but it's going to improve your odds. And that's all you can do as a trader or an investor. There are no guarantees that I'm aware of. If you know of any, send them in to me. I'd love to hear it. There are no guarantees. All you can do is set up a portfolio by evaluating risk or trade stocks based on the risk that you're seeing. One thing with SI, we talked about last night, Max Payne. This stock has Max Payne up at $9.81, I think the number is, $9.81. Now, I'm not saying it's going up there, but there is a ton of in-the-money put premium right now on this stock as we head toward option expiration. Market makers would like to see the price of the stock move higher. Whether it's $2.50, $3, $5, or $10, doesn't matter. Any kind of a directional move to the upside from here would be good for market makers. And looking at the intraday, we started down at 210, went up to 250. Now we're at 228. I mean, the volatility is probably going to be off the charts here, but this is a stock that's incredibly aggressive, but I wouldn't be surprised if we saw a rally. And that was one of the things we talked about. Anyhow, that's about all I got for today. Actually, I want to just point out crude oil prices earlier were down at $69. Right now, they're at $68.20, down 4%. That is breaking down to the low that we haven't seen. We haven't been back in the 60s since 2021. So crude oil prices breaking down. That probably is not going to bode well for energy shares as well in the near term. But it's a double-edged sword. That's the bad news. The good news is crude oil prices are dropping. That's one part of the commodity puzzle that is leading to lower inflation. We were up over $130 a barrel. Now we're half that, right? I'm not making this up. Look at the chart. There's the price. Crude oil prices are coming down, continue to come down. So that should be good for on the inflation front. Anyway, here we are on the market, not quite as bad as what futures were indicating, but still not good. NASDAQ down less on a percentage basis than the S&P. This rotation continues. Now we'll see what happens intraday, but at least at the start of the day, we're seeing some positive rotation into the NASDAQ, which is good. The VIX, though, up to 27. It's going to be a wild second half of March. I mean, there's no two ways about it. I think we got to be really careful, but at the same time, I think we're going higher. So what I'm doing personally is avoiding individual stocks, avoiding leverage. And right now I'm just sticking with ETFs. I like the QQQ, but to each his own or her own. You got to just do what's you're most comfortable. If you're really nervous about the market, I get it. It's hard to be positive about the market when every news story you look at is negative. When everyone talks about how low the market's going to go, they've been saying it for a year now. But anyhow, that's all I got for today. We're going to do this again tomorrow over at Stock Charts TV. Be sure to check that out. Also, if you're on YouTube, please hit the like button and subscribe. Make sure you don't miss anything that we do here at Earnings Beats. Have a great day, everybody. Happy trading.